Hi, I'm Victoria. And Rich Rosa, the co founder of Buyers Brokers Only, an exclusive buyer agent firm serving home buyers in Greater Boston, Southern New Hampshire, and the state of Rhode Island, is my guest today on the podcast Listen Up Home Buyers. Rich, thank you so much for joining me.
I'm glad to be here again. Thank you for having me.
Sure. Now, Rich is also the president of the National Association of Exclusive Buyer Agents, and you're doing a great job with that, by the way. Um,
Thank you.
yeah, and I'm really excited to kind of dive into what we have talked or planning to talk about today. And we're going to give an overview of a couple of terms that we both have discussed and learned that many of our buyers have questions about. And this would be things like, what is a down payment? What's an earnest money deposit, or where you are in the Boston area, deposit, and the difference between fair market value, appraised value, and assessed value. So these are all things that come up on a regular basis. Rich, you want to dive in and get started on this?
Sure. These things are confusing, I think, for some home buyers. I often have clients that confuse the deposit and the down payment and what's the difference. For example, a deposit is or as you called it, an earnest money deposit, is money that a buyer puts up when they make an offer. Now, this is different in different states. Some states, you make an offer with a purchase and sale agreement, and there's one deposit.
Mm-hmm.
In Massachusetts, we have a two contract process where you make an offer. It's called the offer to purchase, and there's usually a smaller deposit, say $1,000 or sometimes more. In this market, it tends to be more than $1,000. And then when you sign the purchase and sale agreement, which typically happens after a home inspection, then you would put down the balance of 5%. And that's
that
the rest of your deposit.
okay.
And typically here, you don't put more than 5% down as a deposit.
And that
Unless, of
again,
course, go ahead.
go
I'm
ahead.
sorry.
Yeah, that is what we call the earnest money deposit.
Correct.
Okay.
Yes.
Yeah.
Yep. And you sometimes you put less. If, for instance, if you're doing a loan, like an FHA loan is 3.5% down, then your deposit might be 3.5%.
Right.
If you are doing some other type of loan, we have some first-time homebuyer programs in Massachusetts where you could put down as little as 3%.
Mm-hmm.
That might be your total deposit. And if you're doing a VA loan and you're doing zero down,
Right.
you may put down whatever you have available
Mm-hmm.
as the deposit. And then, like I said, a small deposit up front, and then the rest at purchase and sale agreement. But I know that's different in different
Yeah.
states.
Yeah, that's
And again, it's
interesting.
called earnest money deposit in most
Mhm.
states. We don't usually use that term here. It's usually just referred to as a deposit.
Okay. And so just so everyone knows, in the DMV, Washington, D.C., Virginia, and Maryland, it's called earnest money deposit. It's typically anywhere between 3 and as high as you would want to go, 3 to 7 to 8, percent of the purchase price. And that money is written to the settlement attorney's office or title office. It can be a check or it could be wired, but the way it works here is you show that up front, and I guess the expression earnest, you're earnest about your purchase, and that tells the seller that you're serious, and they will pull that house off the market and work just for you. Another big question I just answered yesterday with a buyer, what happens if everything falls apart or we don't move ahead with the home inspection after the home inspection? Well, that earnest money is held in an escrow account with your name on it. And if things fall apart, that money can come back to you as long as you haven't done anything egregious, and not met your terms of the contract. So a lot of people will look at that and be concerned, that, well, does the listing agent get their hands on it? And where we are, we have a neutral party hold that money so that the buyer feels more secure.
So it's a little different here.
Wow.
So to your point, if for some reason the deal falls apart, let's say the buyers have a mortgage contingency and then they don't get a mortgage, they would get back their deposits or
Mhm.
deposit, depending on where you are.
Uh-huh.
If, for instance, there was a title defect and the seller couldn't cure that title defect, then they would get their money back. Or like you said, if the home inspection went really bad and they decided
Mhm.
to walk away, they would also get their money back.
Yeah.
Uh, but it is important, and it's for buyers to know, and I tell my home buyers, you can't wake up the day before the closing and decide, you know what, I don't want to buy this house, because in fact you will lose your deposit. And
Hmm.
if you're buying a $500,000 house, 5% is $25,000 that you have on the
Hmm.
line.
Yeah.
So there are certain deadlines uh, where once you get past them,
Right.
it's you are going to have to go through with the deal, or you put your deposit in jeopardy. The
Hmm.
other thing that is different here is we actually have the listing office hold deposits.
Oh, wow.
So we have laws around escrow, and the way it works is that once the money is in escrow, unless the buyer and the seller agree, the escrow agent, which is the listing office, cannot release the money without a court order.
Okay.
So there's no reason for a home buyer to worry about a seller or a listing office taking off with the money.
Hmm.
There's rules and laws around that.
Hmm.
Occasionally, an attorney will hold it, the escrow,
Yeah.
but not often. Not often.
I'm really glad we're talking about this because the fact that people come from all over the country to your part of the country and to my part of the country, they have these ideas, based on their history from where they're coming from. And then when they go to apply it to wherever, we're serving them as home buyers, there's confusion. So just to be clear and kind of an overcap, always check, with your exclusive buyer's agent or broker and your lender, what the practices are where you're purchasing, because this is exactly what comes up when people are confused. They're like, oh, I'm from North Carolina, I'm from California, we do it this way, and it just doesn't apply.
And and so to sort of take this to the next step, this is different. The deposit, or the earnest money deposit, is different from the down payment.
Right.
So if someone is planning on putting down a 20% down payment, let's say, they have that 5% deposit or earnest money deposit in escrow.
Hmm.
And then at the closing, they are bringing with them the additional 15%. A question I often get is, well, what happens to that 5% earnest money deposit?
Right.
And it's part of your down payment. It's just being held in escrow until the closing. So
Hmm.
if you're putting 20% down, so on that $500,000 house we talked about, that would be $100,000 down payment. You'd be bringing in an additional $75,000 to the closing because you've already made a $25,000 deposit.
Hmm.
And then of course you also would have to come up with your closing costs as well. And
Right.
those will vary from state to state as well.
Hmm.
But those are the differences between the earnest money deposit and the down payment.
Right. And I'm glad you brought up the closing costs, because around here, they are typically between 3 and 5% of the sales price. And again, all this needs to be checked with the lender, and it's going to vary depending on the loan you get, whether it's a VA loan. As you mentioned, you can do zero down, or FHA, or conventional. So, I just yesterday, I was working with a buyer, and it was nice to be able to work with a lender very closely with a lot of these details, because the lender had already taken them all the way through to the pre-approval process. And so we could move pretty quickly on making an offer, which we did yesterday. Yeah. Talk a little bit about where pre-qualification and pre-approval, since I just mentioned it.
Sure. So I think people know what a pre-qualification and a pre-approval is. And I don't think there's a lot of, um, in this market anyway, a lot of lenders doing pre-qualifications. I
Hmm.
think, people know that they need to get a pre-approval. They need to offer up some documents to their lender so they could be reviewed. But what people may not realize, and this is becoming more and more common, and I think it's probably the same with you, is that although having a pre-approval and providing your lender with some documents and having your credit score checked and things like that is really important. And
Hmm.
like what I like to say to my clients, going to buy a house without a pre-approval is like going to buy a car without a driver's license.
Yeah.
Um,
Right.
but what really a lot of my clients are starting to do, and a lot of lenders are offering, is what some people refer to as a pre-offer loan commitment, or some of the lenders refer to it as a pre-commitment. And
Mm,
what they are doing is they are going through the entire underwriting process,
right.
reviewing all the documents, reviewing the credit scores, and going through the process that would typically happen after you sign a purchase and sale agreement, but they're doing it before a home buyer even makes an offer. And the benefit of that is being able to tell a listing agent and a seller when you
Exactly.
make an offer, my clients aren't just pre-approved, but
Right.
they've gone through the underwriting process. And at this point, the only thing standing in the way of a closing is an appraisal.
That's right.
Um,
Right.
in fact, you know, every buyer needs to have this conversation with their agent. It's not for everyone, but some home buyers, if they have the additional cash to make up an appraisal gap,
Right.
a shortfall in the appraised price, then they could, at that point, may feel comfortable with waiving their mortgage contingency because they
Hmm.
have the loan commitment. But
Yeah.
that's not for everyone, and that's a
Right.
conversation that every home buyer should have with their agent to make, and their lender,
And their
to
lender.
make
Yeah.
sure it's
Teamwork.
something that they could be comfortable with doing.
Exactly. And it is about the comfort level of the buyer. I often describe everything that we're talking about, in terms of like whether you waive contingencies and whether you escalate and how much, how basically how much you're going to be money you're going to be tossing into the deal. It's sort of like that buffet table at Thanksgiving. There's all these things on the table and you don't eat it all. Some people do, but there's things that you
I
pick and
do.
you yeah, right. Sometimes I've been accused of that, but yeah. So some, you pick and you choose what your comfort level is. And then, then we move ahead with that. And you mentioned underwriters. They're really important. They obviously are the people who, anything that's happening with a loan, you've got your lender who's, guiding you and giving you advice. But then those underwriters are the ones that really clear the loan to close. And so that's when you might get hit with a lot more questions, or more documentation might be needed at that point. So that's an important piece there too. Let's see.
Right, and you make a really good point about sort of the buffet of tools that you have, of a home buyer has to make their offer attractive to a seller, and some of them just won't apply in certain cases,
Mhm.
and other times, they, after asking questions to the listing agent, if your exclusive buyer agent's asking a lot of questions and learning as much as he or she can about the seller, then that may trigger, oh, okay, this would be something good to offer up to the seller.
Mhm.
For
Mhm.
example, sometimes a seller might be purchasing another house, and let's say it's new construction, and we both know that there's usually a deadline, but it's sort of
They
flexible. It's hard
right.
for a builder to finish a house at precisely the exact date.
Right.
And so offering a home buyer offering as part of their offer to the seller a use and occupancy agreement after the
Mhm.
closing, to
Mhm.
give the seller some more time if they
Mhm.
need to get to the closing of their next house,
Mhm.
that could be very attractive to a seller,
Yes.
and relieve a lot of stress on the seller.
Mhm.
And if the buyer has that flexibility, that could give them a great advantage.
Yeah, you bring up a really good point. Around here, it's called the post-occupancy agreement. Just yesterday or day before, something interesting came up, and I don't want to, go too much into each one because we're trying to keep these podcasts short. But I will mention that the post-occupancy is for a limited amount of time, and in this area, it can only be for 2 months. And once you go past a 2-month mark, which you can't with a post-occupancy, you are now creating the landlord-tenant relationship. And it's a very different relationship. And sometimes that needs to be explained. It changes insurance, it changes everything. So you don't want to go even consider entertaining an idea of going beyond that. We just had to shut that down about 2 days ago, where a seller was pushing to stay an extra week. It's only a week, and we're like, nope,
Yeah.
that's a
And
whole different relationship.
And to your point about the 60 days, the 2 months, it's because at closing, there is a document that your lender is going to have the home buyers sign, the borrowers,
Mhm.
which says you are going to move into this property and make it your primary residence within
Right.
60 days. So once you're
Mhm.
signing that document, you're telling the lender that you're going to be in there for 60 days, within 60 days. So that's why the use and occupancy agreement or the post-closing agreement that you talked about
Mhm.
is usually capped at 60 days. And to your point about landlord-tenant, yeah, I mean, the reason why we call these agreements are different than, say, a lease is because you don't want to give the seller the rights that come along with being a tenant, because then
Right.
it becomes much more difficult to get them out
Right.
if they refuse to leave.
Yeah. Another point, we'll move on to the next topic, but fresh in my mind is the property has to be free, broom clean, and free and clear of debris. This often comes up with people who have projects all around their yards. We recently had some people who had a large amount of debris for some outdoor projects they were going to do, and this was all in their driveway, and that has to go, and that's something that we have to remind the sellers that that's their responsibility. They agreed to it in the contract, and if they don't agree to it, that deposit they put down to stay in the post occupancy can be forfeited, because the place has to be clean and clear.
And paint is the big one around here, because it's very difficult to dispose of paint. And so
Yeah.
if you don't want the paint that the seller has stored in their basement or attic or garage, you really need to make
Hmm.
sure they take it with them.
Yeah, good. Okay, so now we're moving on to the fun stuff. Talking about fair market value, appraised value, and tax assessed value. You start. What's it like where you are?
So one of the first things I try to explain to home buyers is the assessed value or the tax assessed value. I don't know if it's called different things in different areas, but the assessed value here is simply something that the city or town does, and it may be the county or the state
Hmm.
in other places, but here it's each city or in town assesses the value of a property, and it's the purpose of that assessment is simply to figure out how much the property taxes are.
Right.
There really is no correlation
Hmm.
between that assessed value and fair market value. Because as
Hmm.
you know, fair
Hmm.
market value is moving regularly.
Hmm.
These assessments happen much less infrequently than the market is moving.
Hmm.
So oftentimes the assessed value might be a lot less than the fair market value when the
Right.
market's moving up. And sometimes it might be more
Hmm.
than the fair market value when the market's moving down. At least that's the case here.
Hmm.
Um, then you throw appraisal into the mix, and that really confuses home buyers.
Right.
What I try to explain to home buyers is a couple of things. One is the appraiser is working for the lender.
Hmm.
Here, the lender hires the appraiser. The appraiser is appraising the house for really one purpose, um, not to necessarily protect the home buyer, but to protect the lender. So the
Hmm.
lender is not lending you $450,000 on a house that's only worth $400,000.
Hmm. Hmm.
And what I also tell home buyers is that if your buyer agent is really doing a thorough comparative market analysis, or what we refer to as a CMA,
Hmm. Same
they're
here.
doing just as much research as that appraiser. In
Hmm.
fact, the appraiser, in most cases, the first document that they get their hands on is the purchase and sale agreement.
Right.
So they know the price that you're paying for the house.
Hmm.
And so they're really looking at that and saying, okay, how do I find some
Similar.
similar sales, comparable sales
Hmm.
that justify this price?
Right.
Um, and it's not to say that they're not doing the work, because they are, and they have software that helps them calculate, okay, well, this comparable house down the street didn't have a garage, but the property that they're appraising does. So their software says, okay, let's add X amount of dollars to the appraised value. But it's a
Right.
very different process.
Right. It
And
is. Yeah.
just like the CMA, if you have 10 appraisers, they may very well come up with 10 different prices.
Hmm. Hmm. Yeah. And the important thing is for buyers to understand that if you have an appraisal contingency in your contract, then that means that if the house doesn't appraise, let's say you bought it for 450 and the appraiser says it's worth 420, that's another point of negotiation between the listing agent or the sellers and you and your buyer's agent. And if you don't come to an agreement on the price, and usually what we do is ask them to lower the sales price to the appraised value, then that transaction can be canceled or voided. So
Yes.
yeah,
And if or in the case of a contract where the buyer has agreed to make up the appraisal gap,
right,
then what happens is, let's say they're putting down 10% on that $450,000 house. So that means the loan is for $405,000.
hmm,
If the appraisal comes in $10,000 low, then
hmm,
what the buyer has to understand is they're still going to get the loan, but the bank is only going to lend 395,000,
right,
not 405.
yeah,
And
good
that's where the
point.
home buyer has to come up with the
Pick up that
10,000 to close
difference.
the gap.
Yeah. One thing I want to mention for anyone who lives in Maryland, if you're a first time home buyer, or really just double check this, because there is a program called the Maryland Homestead Tax Credit. And this is a one time application for a property, but it does help cap that property assessment. So it keeps it under, I believe it's a 10K cap. But I'll put a link to the Maryland Homestead Tax Credit Program for those who are in Maryland and who want to apply for that. Rich Rosa, the co-founder of Buyers Brokers Only, an exclusive buyer agent firm serving Greater Boston, Southern New Hampshire, and the state of Rhode Island, and he is the president of the National Association of Exclusive Buyer Agents. Thank you so much for taking time out of your busy day to be with me here on Listen Up Home Buyers.
Thank you so much for having me. And thank you for doing this podcast. I think it's really helpful for home buyers.